The housing market is on its last legs. Every year, more and more people get pushed out of even having the possibility of having their own home.
The United States is going through a housing affordability crisis.
Correct. Now, this surge is causing many Americans to wonder, are we barreling toward a housing market crash?
A whole generation priced out of their future, treading water just to keep their heads above the currents. Meanwhile, the entrenched upper classes and corporate landlords see their investments skyrocket in value, as the demand for homes continually outruns the supply. But this presents a perplexing situation. If almost everyone is priced out of home ownership, then what's driving this rapid increase in housing costs? And even more importantly, if nobody can afford houses, who's going to be buying these homes in the first place? Well, maybe this is the reason that for the first time in years, house prices have begun to fall in the UK, and quickly. We've seen a 4.7% drop over the past year, the highest level since 2009, and the US isn't far behind. Prices finally beginning to stagnate after years of back-to-back price hikes. And yet even still, it's almost impossible for anyone to own a home. And with stagnating wages and less ownership, what's going to happen to the housing market? Is this the beginning of a crash? Has the market finally hit a breaking point, or is it just going to recover, reset itself, and happen all over again? When you're a kid, you get told that there's a set of goals for you to hit, milestones that make the difference between success and failure. Some of them are getting a college degree, buying your first car, getting married and starting a family. But above everything else, you're told that buying your own home is the key to not just surviving, but thriving. It's not just an outdated picture today, it's a fairy tale. A relic of a time when homes were actually affordable and one salary could support a family. Today, everything's different. Forces like overpopulation, inflation, inequality, and a lack of supply have gathered over generations, putting us right where we are today. If you take a look at how affordable housing is today, it's the worst it's ever been in decades, we all know this. And despite the fall in prices for the UK, there's still a long way to go before average people will have a shot at home ownership. The average home still goes for a little over £260,000, £45,000 higher than it was in 2020, a figure that's over $300,000. Now, a lot of this can be chalked up to the 14 times in the past 2 years that the Bank of England has raised interest rates, making it far more expensive to borrow money. This has meant far harsher mortgages and less people willing to buy, dropping prices. Both buyers and sellers are getting squeezed, and real estate moguls like Warren Buffett know a storm is coming, so they're making their move. In the first half of 2023, his firm sold over $20 billion worth of stock. But when stocks in real estate are crashing, you can still protect and even grow your savings through diversification. Thousands of my followers alone have been doing so, with one of the most unique, reliable assets in the world, fine art. You see, our sponsors and Masterworks have generated over $45 million in art sales and delivered the proceeds to over 50,000 investors just like you. They didn't need art market connections or billion-dollar portfolios. They didn't even have to do years of legwork. They just sat back and watched Masterworks reel off W's. They're at 16 exits so far, with each and every one of them delivering a profit. And with over 850,000 users on the platform, demand is growing by the day. But since my subscribers have been responding so well, you guys can skip the waitlist and start investing today by using my special link in the description below. Past performance is not always indicative of future performance. In the short term, the UK is facing the potential of a major crash. The post-COVID recovery hasn't gone as planned. Everything got far more expensive as inflation outpaced wages. We're now only seeing wages even begin to catch up, when the interest rate was 0%. During COVID and even before, mortgage deals were much cheaper. Lots of people took advantage and got on the property ladder, buying expensive houses. Every house is expensive today, but still, June of 2021 saw the largest increase in homes bought in the UK by a wide margin, over 165,000. In April of 2023, it was just under 40,000 homes sold, half of what it was just a few months before. And it's a similar picture in the US. Over 6 million homes were sold in 2021. It dropped by 1 million in 2020 and is expected to drop a bit over 4 million this year. The average mortgage on the average home with a 20% down payment costs $2,440 a year now in the US, nearly $1,200 less than it was 2 years ago when all these deals were being signed. Lots of these homeowners got in with comparatively good deals, but those fixed rate deals are coming to an end soon.
It's the next few quarters where you'll see the worst pain for the housing market, because the majority of mortgage borrowers in the UK are on fixed rates, and the Bank of England estimates that only a third of the rate hikes that have already been done moment have passed through already.
As those mortgages all get renegotiated to today's interest, it's going to leave people with a massive jump in monthly payments that are still just going to the bank for interest. A massive proportion of people won't be able to make the payments, a similar situation to what happened in 2008. Other costs like energy, food, and the rest have all gone sky high as well, leaving little room for this. The average American is already over $10,000 in debt through credit cards alone. People are overstretched, and falling house prices will only make things worse. Without equity, people will be left without the means to downsize and buy a different house. This is just one reason why it might not be a great idea to sell your house right now. In the UK, home prices have dropped for 6 months in a row. The only thing keeping them up has been the rampant inflation. Real drops are as high as 13% once you account for it, with even more price drops looming. Any home you buy might fall in value by 10% or more within a year. If you only had enough for a small deposit under that amount, you'd end up losing far more money than if you just waited or rented. Massive interest rates also aren't helping things, and they aren't going to go away anytime soon. They make it so much more expensive to pay off a mortgage, especially considering the first years of the deal are mostly paying off interest. This means you'd be stuck paying the banks far more than usual. In a few years, the interest rates will hopefully have cooled down, and there's also the very clear potential of a massive crash right now. Anyone with skin in the game that needs to downsize after the massive hit would find it hard. Everything we just talked about would make it much more costly to get out of a bad deal. It's a cruel circle that tons of people need house prices to fall to be able to afford one, but if they do fall, it will ruin millions of other people's financial plans and stability. It's a result of the shift in views on homes from a necessity and a commodity to an investment. After World War II, when the boomers were being born, buying a home was a lot different. Everything was a lot different really. Compared to our current stagnation, it was a time of rebirth. In the US, this growth was pushed by the GI Bill. To reward the people who fought in the war and restart the economy, the government provided a massive package of aid to veterans. They subsidized mortgages, paid people a year's worth of wages if they were unemployed, and gave out low-interest loans which people could use to build a new life. It was a reflection of a less specific rebuilding project going on throughout the West. In the UK, over 1.2 million new homes were being built between 1946 and 51. House prices remained steady and low for years. More were being built and mortgages weren't seen as financial investments like they are today. There wasn't an expectation of continued growth offset against interest payments. It was this world of prosperity that the baby boomer generation was born into, and they enjoyed the benefits as they were growing up and buying their own homes. But it couldn't last forever. Over time, the rebuilding frenzy died down. More people were born, more families were created, and more houses were needed. Soon enough, demand and inflation started to outpace the supply, and the prices started going up. By now, it was the 70s, and masses of baby boomers had grown up and bought their own homes. There were more mortgages than ever for the banks to play with, but the current model wasn't working too well. Back in those days, mortgages were often shorter, had higher deposits, and a final lump sum to be paid at the end of the term. There wasn't much room for the banks to make interest, and they had to deal with each mortgage individually. They weren't glamorous or particularly good at making large amounts of money for the banks, but one man could see their true potential for profit, and his name was Lewis Ranieri. Lewis was born in New York in 1947 to an obscure, relatively unknown family. After dropping out of college, his first job in the banking industry was unremarkable. Starting in the mailroom at a firm called Solomon Brothers, Lewis spent a decade slowly working his way up the corporate ladder. Early in his career though, his bosses noticed his skills with maths and his ability to see profit where others couldn't, along with his uncanny salesmanship. And so as he went up the totem pole, Lewis eventually found himself in a leading role at the mortgages department in his bank. It would have been a dead end for most, but Lewis's biggest strength was his ability to innovate, and it was here that he would come up with his career-defining idea: the mortgage-backed security. It worked by combining a whole set of mortgages from various homeowners into one asset, which would pay out the interest payments made to whoever owned it. Lewis had single-handedly turned mortgages into a profit bonanza. Using his sales techniques and the help of a banker called Larry Fink, their bank sold them by the truckload to other banks and pension funds across the country. And this was one of the most important shifts in the last century. Lewis had turned what was once a boring commodity designed to let people have homes into something his banker friends could exploit to make billions.
You might not know who he is, but he changed your life more than Michael Jordan, the iPod, and YouTube put together. You see, Lewis didn't know it yet, but he'd already changed banking forever with one simple idea.
The mortgage-backed security. You've got your average person's mortgage. Fixed rate, 30 years. Boring, safe, small payoff, right? When you have thousands of them all bundled together, suddenly the yield goes up, but the risk is still small because, well, they're mortgages. And who the hell doesn't pay their mortgage?
And it was these mortgage-backed securities that would eventually lead to the 08 crash. But for now, it was incredible for the banks. The mortgage-backed security market was worth $150 billion by 1986, just a few years after Lewis had his bright idea. But before that happened, a few other changes in the housing market market led to the disaster we're watching unfold today. As the boomers got their homes and became the largest voting bloc in history, they started favoring laws that would keep house prices high. Politicians obliged, happy to make more money themselves. Housing subsidies ended, the GI Bill never saw modern renewal, and bureaucratic red tape surrounding housing got a whole lot worse. Once the boomers had gotten inside the market, they made sure it was incredibly difficult for anyone else to do the same. It led to the labyrinth maze of zoning codes, planning permission, and arbitrary limits that we know today. The flow of new houses dried up as construction companies had to get permit after permit just to start on a new development. They added years of legal fees, waiting, and paperwork to the process, so even though it was in the public's interest for more houses to be built, it just wasn't profitable for developers. And today, resistance to any new housing developments that aren't more suburban wasteland has gotten so bad that there are protests by pensioners whenever a car park gets redeveloped into more housing. Like this protest in the summer of 2023 in London, where old homeowners gathered to keep their investments safe from a new set of affordable apartments which could replace their beloved car park. Their local MP is right behind them, of course. And all of this resulted in the current view of housing as an investment, something for Wall Street to tamper with, for people to sit on their whole lives, a way to build wealth rather than a basic necessity for survival. This kind of thinking is completely toxic to society. The 2008 crisis was the result of decades of this building up, and Lewis Ranieri's mortgage bonds only got worse and more risky. Banks made so much money off of them that they interfered with the rating agencies, which determined how risky they were. Corruption and collusion meant incredibly risky, awful mortgages were backed up and sold as safe investments. They invested trillions into these mortgage-backed securities, and eventually it all blew up. Millions were left without homes, and the economy went into a nosedive that it's still struggling to recover from. You would expect that such a massive failure of the whole system would ignite a complete rethinking of how we treat homes, but you'd be wrong. The banks got bailed out with taxpayer money, and they pretty much got off scot-free. If anything, the banks have gotten even more reckless and predatory. Firms like Blackstone, Goldman Sachs, and Priti & Partners have bought hundreds of thousands of single-family homes. You don't need me to tell you how awful this is. Aside from the practical effects of increasing demand and artificially raising house prices, it's symbolic of how institutional investors have literally taken control of people's homes. Once they're on the books for these corporate investors, they hand over the management to monolithic letting management companies. These corporate landlords then put the bare minimum into keeping the homes maintained, as well as skipping on anything else that impacts their bottom line. If tenants complain or the banks see more money in it, they get evicted. A 2022 prediction by one asset manager states that if patterns continue as they are, institutional investors could own 40% of the single-family rental homes on the market by 2030. Silicon Valley has also been looking for a way to solve the housing market. Take Opendoor, a company that uses algorithms and a tech-driven instant access business model to try and undercut estate agents. Their basic plan is to build up large amounts of liquid assets and use these to buy homes from people looking to sell. They use algorithms and AI to figure out how much it's worth, buy it for a bit less than that, and then sell it on after a few months. The problem with their plan is that you can't just throw some algorithms, buzzwords, and investor money at the housing market to make money. You still need to deal with in-person viewings, repair and renovation costs, and all the ground stuff to make that happen. And the financial data has been troubling from Opendoor and their competitors, as their stock price has been falling for a straight year.
Shares of Opendoor cratering today after reporting a steep second quarter revenue decline and a pretty weak outlook,
causing them to lose $1 billion in the past year alone. It's clear proof that their business model just doesn't work. Even with all the hype of getting some big names in Silicon Valley to bankroll the operation, it hasn't panned out. Instead, it's just another example of how Silicon Valley's miracle solutions often end up as massive pump and dump schemes to make the founders richer when they inevitably sell the company. The rental market is one side of the story that we haven't covered yet. Everything that we've talked about has led to insane rents. The higher rents go, the less likely it is for people to be able to afford a deposit. If you're paying 50% of your income to some landlord or some Wall Street bank, it cripples your ability to save up anything, and it's a complete drain on the economy. That's not an exaggeration for some, as Londoners are paying over 50% of their income to rent on average. London renters also paid around £3,000 more than homeowners for what is essentially a much worse deal. On average across the UK, renters pay around 34% of their income on average to housing costs, nearly 4 times as much as the 9% that the average homeowner pays. Now sure, homeowners are normally richer than renters, so the figure is skewed by that fact, but it's still a clear example of how the West is changing. The rich get richer and the poor get poorer. What's really destroying the renting market though is the chronic housing shortage. The majority of local councils in the UK haven't built a single home in the past 5 years, despite over 1 million people on the waiting list nationwide. Anyone who's been in the unfortunate position of needing to rent a place in a big city knows how awful it can be. In New York, hour-long waits and long lines of viewers are the norm for even the most overpriced, dilapidated apartments. Elsewhere, it can take months to find a place, with renters often being forced to offer the first 6 months up front, or even the whole year just to get a chance. Add in reference checks and the evasive questions and it's more like a job interview now. All of this, and people get much smaller, run-down living spaces. You just can't build a good life when your kitchen, your bedroom and your living room are all the same room. It's a trap that more and more people can't get out of. In the UK, the renting population has doubled in the past 20 years. And if you're stuck renting, then you're always stuck paying someone else's mortgage, building their wealth and life instead of your own. However predatory mortgages might get, at least there's the eventual promise that you'll actually own the home. Although that's after you've paid years of interest to the bank, and you probably won't actually own the land. You just lease it. It's a trend that surpasses the housing crisis, the movement away from individual ownership. In the World Economic Forum's infamous predictions for 2030, they claim that you will own nothing and be happy with it. This is the key, and it's a big part of why institutional investors are scrambling to get in on the rental market by buying up family homes. They know what's coming because they're constantly trying to create it. The ingredients for it are already here. You don't need to own your own car, you can just use Uber. If you need to buy anything, a drone can deliver to your house. You don't need a cashier, you can use a machine. You never actually need to leave, other than going to the other tiny cubicle where you can spend the other half of your life in artificially lighted work. Might as well get your money's worth for that $3,000 a month studio apartment anyway. You don't need to actually buy anything either. You can just use credit to pay it out over the course of years. You don't need to own a home, you'll be much happier renting for the rest of your life. Even media and entertainment operate off these rules now. Subscription systems and monthly fees are the new norm for everything. It spreads so far that printers and other appliances now have subscription fees. Subscriptions that lock people out of using the thing they bought if they stop paying them. Obviously, most people aren't happy about this. It's a major cause for the underlying resentments you see in people today. But what choice do they have? Take the car example. Most people in America live in places with little to no public transport. Even your own two legs are mostly useless because everything's so spread out and built for cars. Uber and ride-sharing is becoming the only choice. That's despite the fact that it's far more expensive in the long run anyway. It's soon becoming a world where corporations own everything. It lets them extract far more money out of each person. If you're a company and you sell something for $100, obviously you only get $100. But if people rent it though for just $5 a month, they're already paying more in less than 2 years. Turning every transaction into debt simply makes them more money and gives them more power. Ownership is being eroded everywhere you look. Even your own privacy is gone, renamed as data and stolen by these same companies to make the adverts slightly more annoying and effective. It's all part of the modern feudal system that they're trying to create. But most people can't see the bigger picture here. They just see the instant access we now have to every kind of instant pleasure you could possibly think of, and they consider it progress. At our current pace, we may well hit the World Economic Forum's predictions of 2030. Often it's framed as a necessary change in order to stop climate change. The responsibility shifted to regular people, pressuring them to use paper straws, take shorter showers, and generally live worse lives. It's a psychological tactic to shift the blame without even acknowledging it happened. The real damage is done by corporations and governments. Of all the garbage in the ocean, most comes from rivers, and 93% of that plastic comes from just 10 rivers. 8 of them are in Asia, the Yangtze being the largest polluter and the other 2 are in Africa. As for carbon emissions, 71% of it comes from just 100 of the largest companies. The top 20 are responsible for 1/3 of all the carbon emissions. And so the housing crisis is just the tip of the iceberg, and we can only hope that things will get better eventually. If anything is true though, is that everything is always changing. Things can't go on forever like this. The resentment and anger will eventually reach a breaking point. One thing the World Economic Forum won't be right about is that people will be happy with this new normal. That's at least something we can count on. With all this said though, what's going to happen next? For now, the housing market looks like it's on the brink. With far less people selling, movement has been propped up at the upper end through cash purchases of million-dollar homes in capital cities. There definitely isn't anything shady at all about these anonymous buyers.
Right. You know, I've been paying attention to these companies that are buying up affordable housing.
Yeah. Like BlackRock and Zillow.
Yeah, that's scary.
It is scary.
That's scary because if they can move the entire country into renting, like
that's right.
Nobody can own it.
Well, that's what they want to do.
Right. That's what I'm saying.
They don't want anyone to own anything.
If you get a giant majority of the population that are just renters, that don't ever own property, they never have their own real home.
Yeah.
And then you make sure that you control their wage because you have massive corporations, whether it's Target or Amazon or whatever, and they limit the amount of possible growth you have within a company.
Yeah. And there was that article, you'll own nothing and be happy in 2030.
That is wild.
Rents have been going up as well, as they have been for years now. And increased mortgage costs have put a dent in landlords' bank accounts, of course, but not enough to compensate for the massive price hikes we see today. The result is a whole generation locked out of the entire system and exploited for what little money they do you have. It's a big reason why so many people are forced to just stay at home, well into their 20s and often much longer. Without rich friends to house share with, or very rich parents that can subsidize deposits, there isn't any other choice. In the UK over the past decade, over 620,000 more young people are living with their parents compared to 10 years ago. It's not just a problem caused by the housing crisis, though obviously it does carry a lot of the blame. The pandemic wrecked so many people's social lives and confidence that it's keeping people at home years after. It also put the brakes on tons of people's plans, throwing a wrench into any hopes they might have had of moving out. Men have been more affected than women, making up 2/3 of the young adults still at home. Often a comparison is drawn between other cultures, where children often stay at home for years after graduating or entering the workforce. But this can't be a reason to say the situation isn't a disaster on a societal scale. It should be a choice that people can make, not something they're forced into. Then there are those people who aren't lucky enough to even have the option. They're stuck in a world of private rentals, housing shares with strangers, and exorbitant rents. Nobody can truly and accurately predict the long-term future of the housing market. But what you can do is look at the historical precedents of these kinds of situations. When millions of young people get shut out from success, it undermines their reason for participating in society. If you know that hard work won't pay off, what's the point? Historically, a large population of young men and women completely disenfranchised isn't a predictor for success. They can only take so much before they either give up or look for a different, revolutionary way to make a good life for themselves. We're already seeing the first of these things happening all the time, and it won't be long before we see the second.